and I'll start admitting. Let's go to people, admit all. Here we go. Morning, Alan. Morning, David. Morning, Derek. Morning, John. Morning, John Spain. Morning, Nicola. Morning, Peter. Morning, William. Good morning, Peter C and Peter B.
Hi, John.
And morning, Charles. Morning, Jim. Oh,
Hey guys, morning.
Morning, Neil. Very kind of you to join. Hope you've all had fantastic Easter breaks. And the Easter Bunny was kind to you. Hopefully not too much chocolate. If you've just joined, if you could mute, please, that would be great. William, if you could mute, and Charles, if you could mute, that would be excellent. Just to cut out any background noise. And John Spain, if you could mute as well, that'd be brilliant. Thanks for joining. Morning, Shay. If you've just joined, if you could mute, please, that would be excellent. Thank you very much. Morning, Juna. Is that the right, Juna? Juna? Good of you to arrive and join the session today. Morning, Charles. If you've just joined, please mute. Thank you very much. Thanks for doing that. Great. Let's mute and mute. Thanks, John, for doing that. Brilliant. Okay, excellent. Few more joiners arriving. Morning, Richard. Thanks for joining.
Hello.
Let's just see if you can mute, Richard, that'd be great. Thank you very much. Okay, 10:32. So welcome everybody to this morning's coffee morning. Delighted to have Dr. Con Keating presenting on LDI, 18 months on. I'm sure you're going to be very aware of the problems that LDI created, and as we all know, Con is very passionate about this subject. He's passionate about all subjects, I think, but especially this subject. So what I'll do is I'll pass to Henry. I'll monitor the lobby. As usual with Pension Playpen, if you would like to ask any questions, please raise a hand. We will also open the chat room, and if you want to put any comments in there, please put a comment in the chat room. As you know, Henry and I like to unmute you and ask your question if possible, but I think the lobby is now full, which is good, so that's great. So Henry, without further ado, I'll pass to you. We are recording as well, by the way. Everybody's happy to be recording. William, happy to be recorded. Alan, yeah, Charles,
Okay,
thank you very much. So
Steve.
we are recording.
Right.
So
without further ado, over to you, Con.
Okay. I'm just going to walk through a couple of issues which Ian and I think are really significant in terms of their consequences for public policy. And specifically, what I'm going to be focused on today is the quality of TPR's published data. Ian hopes to be here, but he's on a train between Glasgow and Leeds, so don't hold your breath. So let's just go to the beginning and look at the biggest of the problems, the most serious one, which is to do with assets. And we have two sets of asset estimates which are published quarterly, or which have been published quarterly. TPR's estimates were only really publicly published in the LDI report, which came back in February. They had shared with me their data for most of this period earlier last year, but there are major revisions between the data they supplied to me and the data in the LDI report given to the Work and Pensions Committee. Now, what I want to draw your attention to is just the difference between TPR's numbers and ONS's numbers. Now, until December of last year, the differences between ONS and TPR and PPF were trivial. They were all within the realm of estimation or confidence error. Now, what we've seen over the period since the beginning of the crisis, and I date that from the end of 2021, when we really saw rates beginning to rise. Now, over that period, TPR believe that, or would have us believe that assets have only declined, and this is in the period to September 23, and they have only declined by 23 and a bit percent, 23.4 there, 419 billion pounds. By contrast, the ONS's numbers have declined by 38 and a bit percent, which is just shy of 700 billion pounds. The difference between TPR numbers and ONS numbers is huge, 279 billion pounds. Now, we can augment this with some values for TPR asset, for PPF asset values, rather than just TPRs. Now, this goes as far as December rather than simply the Q3 2023. Q3 2023 figures large in things which the pensions regulator has said to Work and Pensions Committee, and indeed in various other places. You'll see that there is a material difference between PPF's assets numbers and TPR's asset numbers. Almost 120 billion pounds of difference, 117 billion. Now, what I want to draw your attention to is the difference between TPR and PPF, and how that has changed over the course of this period. And this is a graph showing ONS as the green line at the bottom, then the PPF numbers in dark blue, and the red numbers of the pensions regulator. Now, the pensions regulator sees asset values, and asset values are basically an objective fact. One really knows the value of an asset portfolio with considerable precision. We have the widest gap where the where the TPR is, I've lost my screen, stay with me. I now can't see my screen. Rescue me, Steve.
Is your screen still up? We can still see it, Con.
We can still see it, Con. Yeah, we can still
We
see
can
the
see
screen.
it, but Con can't see it. That's the point.
How do I?
Okay. Where are you? You're on. If you you seem to. What about in the bottom right display settings? Does that help you? If you click one of the icons down there at the bottom of the screen on the right.
No, I don't see anything down in the bottom right.
Oh,
Sorry about this, folks.
That's all right. If you press escape, try and
Right,
press escape.
it's all right. I seem to have got it back.
You got it back. There we go. Great. Okay. Brilliant.
Right. Let's go back to that slide. The point I would be making here is TPR's value relative to PPF's goes from as much as 100 billion under PPF's estimate to as much as 90 billion over. Now, you'd expect a fairly stable relationship between the two, because they are covering what is, to all intents and purposes, the same basic set of pension funds. The problem that we have is really very simple. The data which TPR has is stable. It's between 2 and 4 years old. They've stated this, and it's actually shown in the purple book. And to that data, the PPF then applies its models and comes up with asset values. If you look at that diagram, you'll see that for half a year, PPF has actually been moving in a very different direction to that of the ONS estimate, or indeed from the PPF. Something is pretty rotten in the state of Denmark. So let's go to technical provisions and just look at what the PPF or what TPR would have us believe. Top 2 rows there are the asset numbers we saw on the previous slides, to which I've added the TP, the technical provisions liabilities of the pensions regulator. I'm going to be coming back and talking about some of these estimates of the pensions regulator because I think they are actually a bit too high in recent times for reasons I will explain. But you'll see the result is there in the funding ratio. We see TPR's estimate of funding ratio go from 103% to 127%, and it stays around 127% in December and the period after. ONS, by contrast, actually declines marginally over the year. This all comes about because ONS's decline in assets is materially larger than that of the pensions regulator. This carries with it consequences for the number of schemes in surplus. On these numbers, TPR now believes that at the end of September 2023, 87% of schemes were in surplus on a technical provisions basis. That number becomes 88% in their reckoning in December. That means that we have around 600 or so schemes which are in deficit. By contrast, the ONS figures would imply 57% of schemes are in surplus. I'll come back to that number again because the change in liability values, which I think is appropriate, will raise that 57% quite materially, but to nothing like 87%. So, should we trust the ONS data? Well, this is the sampling that ONS does, and it covers just 12% schemes by number, but 70 to 75% by assets. Now, Ian and I last year collected a hell of a lot of scheme data. We had scheme data for 22 and 23 from some 847 individual schemes. So we decided to conduct a little experiment. We took the data that we had, broke it into the classifications you see above there, and fitted distributions to them. We then used those distributions to simulate samples of 614 from that. And in this bottom table, you'll see survey March 22, March 23. Our 640, our average 614 sample from the distributions that we had fitted to the data we had was 1,190 for the March 22 date and 938 for the March 23. So that's just down by 21% or so, which is perhaps low by comparison. But of course, that 614 sample is heavily biased by large schemes, which typically would do rather well. We then take the figures for assets published by ONS in both March 22 and 23, and the equivalent figures for PPF and TPR. And from those figures, in the final three columns, we show the difference between the estimate of what would have been filed by the 614 of the ONS sample to see what the difference is in the non-sampled group of schemes. And we see that we have a £516 million non-sampled part of the universe, and 306 in the other. That's a decline of about 40%, which is high, but based on what we've seen, not exceptional among small schemes. Small schemes who were heavily committed to LDI strategies really got very badly wounded. Returns on LDI funds of -70, -77, -82 were not rare. But the important thing to note here is the right-hand two columns. If we subtract the sample estimates that we've made from the PPF and TPR declared asset values, we see 479 and 502 for the PPF. So the PPF would have to have increased the assets in that bottom 4,500 schemes. And we also see the same thing, slightly more exaggerated, in the case of TPR. Neither PPF nor TPR gross numbers, published numbers, are, in light of that, credible.
Con, can I just ask you a question at this point?
Yeah.
Because that's such an important statement you said. How can you just go over again, for those of us not as mathematically able as you, just how you managed to extract that data from the PPF and TPR sets?
We had the assets, liabilities, assets and liabilities of 847 schemes for both March of 22 and March of 23. What I did was I then took those 800 odd and divided them into the same categories as the ONS survey shows. We then fitted, or I then fitted, distributions to the samples I had in each of those categories. And in some of the areas I had further data points which I could use to augment, which was either March 22 or March 23. But net, I fitted distributions to the samples of asset holdings. And from those distributions, I sampled randomly within those distributions to arrive at an aggregate sample sizes. I repeated the exercise of 5,000 iterations, and I just took the average, the median of those as the value that you see there, 1190 and 938. Now, what I then do is deduct those values from the declared total asset values published by ONS, PBF and TPR, and look at the residuals. And the residuals for the 4,600 schemes not sampled, those residuals declined from 500 odd to 300 odd for the ONS data, a decline of about 40% in the asset held by those 4,600 non-sampled schemes. The equivalent for both PPF and TPL is that the values, rather than declining, actually increase. So implicit in the TPR and PPF numbers as a result of this experiment is that they would have us believe that the assets held by the bottom 4,500 schemes increased over the period, which is a patent nonsense. Is that all clear, Henry?
That's very clear, and hopefully there is another question that's come in actually as a result of, presumably. Stephen, would you like to ask your question?
Just a very quick follow-up. Since you've done it so carefully and run a simulation, have you any feel for what the margin of error is in these calculations? I mean, how dispersed were your estimates that you took the mean of, or the median of?
The standard deviation of asset returns in 2022 was 24.3%. The standard deviation in 2023 was 25.1. If you want to, what's a level of significance in any of this stuff? Between 2 and 3%.
Yeah.
You expect sampling error of the order of 2 to 3% using the techniques that ONS uses.
Okay. Thank you.
I mean, if we look to ONS revisions, they have all fallen within that 2 to 3% number. So it's pretty reasonable to believe the statistics.
These are good working numbers. Thank you. Do you want to carry on, Con? Because there's any further questions.
Now, next, I just want to show the levels of liabilities for the 3 different classes of scheme. That's technical provisions, low dependency, and buyout. That's what the green area at the top here shows. You can see that the liabilities declined by 38% for technical provisions, by 42 and 44 for low dependency and buyout. We can have a discussion about those relative values separately later if you wish. The point that I want to bring out here is quite simple. It's that we have seen, if we take the ratio of low dependency to technical provisions and the ratio of buyout to technical provisions, we see that low dependency, which started in December 2021 as 117% of technical provisions, is only 108% in September, and not here at 106% in December. Buyout is even more dramatic, from 132% down to 118%. And then if you perhaps, to get a grasp of how significant this stuff is, just look at the excess cost of low dependency and buyout in the bottom 2 rows. Low dependency would have cost you 302 billion relative to technical provisions in December 21, but just 89 billion in September 23, according to the TPR's reckoning. Buyout goes from being £500 billion to just 196 billion in September 23. These are staggering moves. There's just a graph here which shows the relative movement of the two data sets. Most of this appears to have happened early on in the data set, as you can see from that graph. So what I did then was I said, okay, well, we have a technical provisions value, we have a buyout value, and a low dependency value. So I can then work out the implicit spread on technical provisions from those two other numbers. I will start with the assumption that buyout is gilt plus and low dependency, as I say, is gilt plus a half. I then calculate what duration gives us those two, what duration and what addition to yields gives us the technical provisions level that could generate those n values of the published data set. I get a 22-year duration and 106 basis points when I make the assumption that buyout is gilt flat. And that reduces to a 16-year duration and 100 basis points in 2023. Now, so in other words, TPR has in those estimates applied a decline in discount rate associated of a quarter in the discount rate applied to technical provisions. Now that's predicated on gilt flat or buyout. When I go to a more sophisticated modeling of buyout spreads over the period, I actually arrive at these durations and these spreads, which strike me as being very reasonable. Again, there is an explicit 25 basis point cut which must have been applied by the regulator in that data set, and the other 6 basis points that are running around there are variations in buyout spreads. So now that cut implies a 4 to 6% overvaluation of liabilities at the end. Okay. That would increase your funding ratios from 127.4 to 134%. That means you'd have schemes in deficit by ONS, about 31% of schemes, about 1,500. By TPR, it would be just 8%. That's 400 schemes. That would rather clash with the PPS estimate that there were 596 schemes in section 179 deficit at that time. I think that it suits the regulator to have the relative cost of low dependency in particular, but also buyout, look not that high as we are trying to put through the new funding regulations. Let's go to buyout, just for completeness. Here again, we see the asset values, we see the pension regulators' buyout values, and the funding ratios. A huge increase according to the TPR, from 78% to 108% funded. That's a 30-point increase. The ONS is an increase, unlike the earlier technical provisions I showed you, which showed a small decline. Here it comes across as a small increase. The one thing I would draw attention to, or rather warn you to avoid, the revision of the 25 basis points is actually only to technical provisions. Buyout, they are pricing gilts flat, or their estimate of gilts or whatever, their estimate of deferred and pensioner buyout quotes. The same is true for the spreads on low dependency. They are fixed, so not affected by the change in technical provisions asset as liability estimate. So by TPR reckoning, 56% of schemes can buy out currently. That's, roughly speaking, 3,000 schemes. The surplus by ONS reckoning is actually only around 1,500. That is still a material increase. It's a fourfold increase, or a threefold increase over where it was at the beginning of this. And I would say that what one can't do is judge very closely from the level of demand for buyout. If there are 1,500 schemes looking for buyout or 3,000 schemes looking for buyout, you're not going to see that being shown as much of a difference in terms of inquiries of buyout insurers and so on. The problem is rather less in number who are capable of buying out, but in the aggregate position. I mean, you had an aggregate cost to buy out, according to the pensions regulator, at the beginning of this period of £500 billion, 503 million pounds. And the ONS figure was slightly lower, 473 billion pounds. Now, by the end of the period, by September 23, TBR would have us believe that schemes have, in aggregate, a £99 billion surplus on a buyout basis, whereas the ONS number shows that as being 150 billion deficit, which is a huge difference. The improvement, according to TPR, over the period is 602 billion. The improvement by ONS reckoning is just 323 billion. Now, I just want to draw your attention to one other aspect of buyout, which is the Purple Book. The Purple Book reports its calculation buyout value as being 2,105 in March of 2022 and just 1.255 trillion in March of 2023. TPR, by contrast, reports 2,108 and buyout values in 23 of 1.441 trillion. That's the difference in the estimate of the buyout value in 22 of just 3 billion, which is just statistical noise. In 2023, you've got 186 billion of difference between PPF's estimate of the buyout cost of all schemes and 1.44 trillion for the TPR. Something is rotten in the state of Denmark there. Now, let's go to low dependency, which is the most important of these parts, as this is what the current funding regulations and the sometime to be released new funding code are all about. By this, we have just TPR's low dependency numbers. And we see, according to the mentioned regulator, low dependency funding increases from 88% to 117%, a 33% increase. By contrast, the ONS number is much more modest. It increases from 89.4 to 96.3, which is just 7.7%. The number of schemes in deficit on a low dependency basis, according to TPR, has gone from 77% at the beginning of 2022 to just 20% in September 23. That's a huge increase. It means there are just 1,000 schemes out there who are unable to go directly or do not have sufficient assets to operate low dependency. This is overwhelmingly the reason that the impact assessment, which accompanied the regulations in draft, showed a cost of 177 million, when the real number is probably 150 billion or more. And we'll come back to that in a moment. ONS, by contrast, does show an improvement. There are 75% in deficit at the beginning of the year and 54% at the end of the period. So about 2,500 schemes in deficit. The number which is most important here is the shift in surplus actual amounts. We see a 450 million shift for TBR from a deficit of 245 billion to a surplus of 206. ONS goes from 215 deficit to 43 deficit, a shift of just 172 billion. This is critical to understanding how how the pensions, how the DWP's impact assessment on the new regs could have been arrived at. So let's just deal with one other point. TPR actually states at one point in one of the documents that the surplus of schemes in surplus is 225 billion. At that time, the aggregate surplus was 206 billion. So the aggregate deficit schemes in deficit, according to this, is 19 billion. Now, the aggregate surplus, according to the ONS at that time, is minus 43 billion. So deduct the difference all around, and you get a huge deficit for schemes in deficits, 200 billion. Of course, all things aren't equal. So our own modelling has suggested that the total deficits lie in the range 150 to 200 billion, which means that schemes in surplus would be in the range of 57 to 107 billion. There's a net cost to the new funding regulations, which is very substantial. Why does any of this matter? Well, it's fundamental to the impact assessment. You can have no confidence in that impact assessment. The costs actually look to be really high. If the ONS figures are right, this is going to be a significant new funding requirement on schemes, on their sponsors. And that is about as counter to the long-term productive investment policy of government and the Mansion House Agreement as you can think of. Taking money out of the sponsors can only reduce productive investment. The cost of corporate taxes not collected would be of the order of 30 to 40 billion. With pressure to shorten, that's an annual cost to the Exchequer of between 3.5 and 8 billion pounds. I think, and Ian agrees with me, We think it would be sound and rational risk management to defer passage until these differences are resolved. So we can ask, have we learned anything in here? Well, let's have a look at leverage. And what we've got here are the ONS figures for repo, for gross swap exposure, and for pooled funds. And you will see that there are some quite substantial declines, but those declines really are not that significant when you look at them in the context of the size of scheme assets or scheme liabilities. Down below in purple, we have the first of the two sets of purple data. Repo was 10.7% of scheme assets at the end of 2021. It's 10.2% now. That's not statistically different. Swaps have increased, and that is statistically significant, from 14 to 18%. Pooled funds have 12.7 to 12.6. When you measure it, as you probably should correctly, relative to scheme liabilities, you see, broadly speaking, very, very similar numbers. There's actually less leverage here in just one aspect, which is the pooled funds. Pooled funds at the beginning of 2021 were probably operating an average leverage between 3 and 3.5 times. That is today, I'm told, between 2 and 2.5 times. Now, what that means is that from this degree of leverage, it is most unlikely that anyone will recover the losses which they made through the crisis. So my takeaway on this, have we learned anything? At least with respect to leverage, my answer would be no. I don't quite understand. Just want to touch on deficit repair contributions. Deficit repair contributions have declined. The quarterlies have gone down from 3.5 billion a month at the beginning of 2021 to 1.1 billion in Q3. Q3 is typically a light quarter for deficit repair contributions. I'd expect the December number to be around 1.6, 1.7 billion. The key point here is a very simple one. These are almost insignificant in terms of funding of schemes. 0.8% of scheme assets, scheme liabilities. 1.11% of scheme liabilities at the maximum. Deficit repair contributions really don't make that much difference in the short term. They are, by contrast, very important in terms of corporate finance and corporate investment. You've got corporate investment, corporate new capital investment of 30 to 50 billion a year. If 14 billion was being diverted to pension schemes, or 8 billion now, that is going to depress the levels of corporate investment, and has been. And I think is one of the reasons we have seen such lackluster improvement in productivity. Then I just want to draw attention to assets and liabilities at the end of the year beyond ONS. We see TPR and PPFs asset increase numbers. We see PPF estimating assets to have improved in the last quarter of 2023 which was a raging bull market in bonds, by 98 billion. By contrast, they have DPR has an increasing by 146 billion. These are assets that we're talking about, and we can't estimate to within 50 billion. I mean, it's just amazing. Our modelling, which is not TPR's modelling, actually suggests that the improvement in asset values would be about 86 billion. One of the things that should be drawn attention to is that 86 billion is 7.5% return on the original value of assets there, which is actually better than PPF's 98 billion. So this is an effect arising from the fact that the earnings being made are on a smaller capital sum in the case of us and INS. This is the variation due to liabilities, and we find a very similar values for liabilities to ONS. Well, actually, quite a bit lower than ONS, but ONS versus PPF, and of course the PPF number is a Section 179 value. Now, if we then look at this, is what's happened in terms of the funding ratios. We think they got worse slightly. They think they got a little bit better. And then, as if it isn't enough, we see discrepancies all over the place. In their LDI report, which we saw in February, and we saw then the landscape report literally within a few weeks, we see liabilities in the LDI report reported as being 1203. If we look at the landscape reports, they show liabilities at the same time as 1236, a £33 billion deficit. Surplus in one case being 212 billion, and in the other 179.
Can you just clarify where the LDI report, I think, is the one that appeared in the WPC, yeah?
Yeah, the LDI report was to the Work and Pensions Committee.
Yeah, okay.
The landscape report is an annual report that TPR produces every year.
Okay, so the LDI was a one-off, the landscape's their ongoing one.
Yes.
Okay, thank you.
Yeah. That brings me to the end of all of this talk.
You're on mute, Henry.
You're on mute, Henry.
Sorry, the fact that there have been so few interventions suggests that was probably quite clear, but I do see a hand going up. So if your hand has gone up, I will try and find out who it is. It is Peter Cameron. Be very pleased to know what your question is, Peter.
Right. Good morning, everybody, and thank you, Con, for an excellent presentation on your research. And I think this is highly significant and needs to be widely promulgated, particularly as we're going into the DB funding regulations and funding code process at the moment. I may be naive, but I just tend to think that when the LDI crisis first emerged, the TPR and PPF and various other people said, oh, it's all right now, the liabilities have gone down, even though there's this loss of asset value. But the liabilities have only gone down because the TPR and whoever else is doing it has assumed future income from the existing investments will have doubled because the gilt rate has gone up by from say 1.8% to 4.6 or 4.5% currently. So therefore you're going to get more income. But then when you look at the actual assets, their income earning capacity has deteriorated the quality of those assets. There is much more assets in no income, such as LDI funds, leveraged LDI funds, or low income categories, such as gilts, particularly index-linked gilts, which have a negligible annual coupon. So I wondered if you had any measure of that, of the impact of the quality of assets at the evaluation dates.
No, we haven't done any work on changes in the quality of assets. Frankly, because we just can't do it on a sufficiently large scale to make any output meaningful. There are a few things which are worth talking about. The first of which is that if you have interest rates at 1% and you have a spread over of 0.5%, then roughly speaking, a third of your discount comes from the margin you've assumed. When that becomes 5% and you're a spread over of 0.5%, you're actually down under 10% of the discount coming from the spread. So spread as a way of measuring risk or providing for uncertainties in things is a very, very bad way of going about things. You will finish up with, if you're regarding the spread as being a risk buffer, it's enormous when rates are low and it's very small when rates are high. I look at the returns on assets. If I had a return on equities when rates were 0.5% of say 1% or 2%, then what do I expect when rates are 5%? Well, I don't expect it to remain still or steady at 1 or 2%. I expect the business outlook to decline and the expected return on assets to decline. There are a lot of cross currents going on in that stuff. Yeah. There we are. Further questions or comments? Henry, you're on mute.
Thank you, Con. The question that Andrew Young raises is interesting as to whether any consultancies have looked at their books and broken them down in similar ways. One or two consultants on the call. I'm not expecting you to answer on your behalf, but one to think about. Do we know of anybody who's actually done it?
No one's done it as comprehensively as we have. We have been, the data that we were supplied with, the two consultancies supplied us with over almost 300 of the returns that we based all of our own analysis on. Have they done it themselves? Some of it's been done. Yeah.
Sorry for keep on going on mute. I have aeroplanes going over my head, which makes for a noisy experience for you. A question from John. John, do you want to ask the question yourself? It's quite an interesting question. Or do you want me to ask it for you? John, you come
Uh,
off mute, that's fine.
I guess I've got a couple of questions on there. The latter one is, thank goodness for Connie and doing this work. I know it's not a huge army of people. It just beggars belief why TPR, with a legion of staff now, can't have some people accessing proper scheme data. But I guess the broader question is, how do we get TPR to take this data seriously, and referencing also to the Works and Pension Committee's third report on TPR's attitude to data and information. So that's an important report. I'm sure the audience today, I think we are probably the audience of the who are sympathetic to that report. But how do we get others, in particular Parliament, to take seriously what is a very serious and robust paper by the WPC?
Well, we've already got the kick up the arse for the pensions regulator in the form of the latest DB report from Work and Pensions Committee. The very first thing they do, and the very first of their 23 recommendations, is that TPR and ONS should get together and get to the bottom of this bloody difference. It's interesting because the ONS used to publish this data quarterly, but as they are moving towards trying to publish liability data also, I gather that this is going to be published biennially going forward, with 2 quarters being reported at a time, with the next report date being September 19th. But in terms of resolving the differences with between TPR and ONS, the Work and Pensions Committee said, really, go away and sort it out. What they haven't said in that report is go away and sort out the differences with the PPF. I mean, the thing which is just unimaginable is that PPF and TPR actually start from the same data. So those differences just come about because of the different models that TPR and PPF apply. They are producing variations that are just nonsensical.
I have a question of my own, if I may, Con. There was a question that was asked by the WPC, maybe at that session we did together, and they said, when do you think we will finally get definitive answers to these questions? And I put it to you.
We will get more of the picture in 25, 26, 27. TPR's data is 2 to 4 years stale. So we'll see the formal triennial valuations and so on by then. The point I would make is that the differences are ongoing. The investment return, when you're looking at assets which are £200 billion lower, 5% return on your assets, that's a £10 billion a year difference. So there are going to be effects which compound the original losses arising from the collateral calls and mainly scheme rebalancing. A lot of the swaps that were cut and so on were pretty costly. I mean, the loss due to simple repo leverage in the 22 year was around 66 billion. Yeah, that isn't coming back.
On that rather sad note, yeah, I noticed that we've reached the end of our allotted hour. Thank you, Con. Thank you, Ian, too, for the work you've done on it, even though we failed to pick you up on the trade. Can I have a round of applause from everyone, either virtual or whatever? Thank you very much indeed. I'm going to...
Oh, one thing I will say, someone asked, will slides be available? Yes, of course.
The slides are going to be made available to anybody on request to me.
Please email Henry or me. Yep, that'd be fine.
They will be on my blog if you want to download them. If anyone doesn't have my age wage address, it's really simple. It's henry@agewage.com for them. So that's for you, Charles. You do have my address.
Thank you.
Thank you very much to everyone who attended. It's not often that you start with the same number as you finish. We have today. And it's not often that I look around the faces and I see such rapt attention. So, Con, you've done a great job in helping us understand these things, and an even greater job in doing the work in the first place.
Yeah.
I'm sorry I couldn't get to all the questions, but I think we're now at an end. Back to you, Steve.
Yeah, okay. Thanks everyone for joining.
Sorry,
Con.
If there are any questions which were not asked and unanswered, if you can send them to me, I'll answer them and do it by email or whatever.
Yeah. Okay. If anybody wants Con's email address, then come to Henry or to me. That'll be fine.
Yeah.
So brilliant. Con, thank you very much indeed for your input, and obviously Professor Ian Clacker's input as well. Next week we have update on the pensions dashboard. Hot news, DWP guidance is out. So if you are interested in pension dashboards, or you know any providers or advisors that are interested in pension dashboards, please join us next week. It's a really big issue, and hopefully a fantastic step forward to join members with their providers. So I think it's really good. And as usual, we pray for peace in the East and peace in the Middle East. And the video of today will be up on the site in the next hour or so on the Pension Playpen site. You just have to log into pensionplaypen.com and click on the media tab. So Con, thank you very much indeed for your presentation. Really appreciate that. The slides will be available. Please email Henry or myself. And we wish everybody a pleasant day and a good week. And we'll hopefully see you at the next coffee morning presentation. So really appreciate that. Hope everybody's safe. All right. Take care. Thanks a lot. Cheers. Bye. Bye.